If you've looked at your 401k recently, you were probably not at all happy with what you saw. So how can you protect your 401k and other hard-earned retirement savings from being depleted as you watch the market drop? Here are 3 things you need to know. Don't panic. It might sound counterintuitive, but for most retirement savers, the best thing to do is to do nothing at all. Advisors say most investors should leave the money in their 401k right where it is, especially if retirement is a few decades away. Also, if you have a practice of contributing regularly, keep doing that. Many investors see drops in the market as opportunities to buy into equities while they're cheap, and then wait for them to rebound in the long run. The most important thing to remember is you haven't lost money until your investments are sold. If your account balance is lower today than it was yesterday, that loss only exists on paper, unless you sell. Some volatility is normal, so it's a good idea to come up with a financial strategy before the markets make big moves, and then stick with it. If you haven't looked at your asset allocation in a while, now's a good time to make sure it's still aligned with your age and risk tolerance. Asset managers recommend you have a diversified portfolio with numerous asset classes under both equities and fixed income. A balanced mix of stocks, bonds, and cash can be a good plan for the long term. Financial advisors typically factor in some market volatility and potential downturns when they craft a financial plan and determine a portfolio's asset allocation. Make sure to keep some money in cash. While you might be tempted to snap up stocks while prices are down, be sure to set aside enough for emergencies, as well as a fund you could draw from if you plan to retire soon. Financial planners recommend keeping at least 6 months of living expenses in cash. If you're planning to retire soon, you might also consider keeping money in short-term investments, like US Treasury bills or certificates of deposit. If you plan to retire in the next 5 years, some advisors suggest keeping at least 3 years' worth of expenses in cash, short-term CDs, or US Treasuries. And if you're nearing retirement now, you might want to consider working a little longer to avoid spending your retirement assets. Or if you're already retired, take up part-time work. Anything you can do to avoid drawing down your retirement assets will benefit your portfolio in the long run.